Hey everyone, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, I'm speaking with Brian Jacobsen, Chief Economist at Annex Wealth Management. Brian, thanks so much for joining me.
Oh, it's my pleasure.
Brian, we just got this big jobs report come out, and it showed job gains that were less than expected, quite a bit less than expected. I think it was 12,000 jobs created in the month of October, but that seems to be distorted by the Boeing strike as well as the hurricanes. What are your initial thoughts on this number?
Yeah, there were lots of distortions in it. And the number could have been anywhere from like positive 200,000 to minus 100,000. It kind of seemed like, just because we didn't know how the hurricanes would have affected the number. My guess is that it probably lowered that headline number by about 100,000. So if we take the 100,000 distortion from the hurricane, and then we also add back the numbers from the Boeing strike, the Bureau of Labor Statistics says that was maybe a 44,000 number, and you add to it the 12,000 that we got, you actually get an okay number of something close to a 156,000. That is a slowdown from what we have been seeing over the last 12 months. It's averaged around 194,000. So we are seeing some of that slowing. I think it was notable, maybe most important, that we saw those back month revisions. So for the month of August, the number was revised down by quite a bit, down to plus 78,000. And then for the month of September, that number, which came out at 254, was also revised down. So those back month revisions, I think, are the ones that were most important and have me thinking that the Fed is probably going to have the green light to do a 25 basis point cut when they meet on Thursday.
Brian, you mentioned the jobs numbers that we got in previous months, 78,000 in August, 200,000 plus in September. Now, a normalized number in October of something like 150,000 or so. It seems like there's a lot of volatility in the jobs data recently. Does that concern you, or is that normal?
It does concern me a little bit, especially the weakness in August that we saw there, because when it's below 100,000, it kind of raises a little bit of a red flag. It didn't stick there, so maybe that was just some seasonal adjustments. August is always a hard one for the government to do their seasonal adjustments, because in some instances, schools, they go back late July, sometimes it's August, sometimes it's in September. So you get all these weird variations. And so maybe part of it is the seasonal adjustments that's supposed to smooth things out is actually contributing to some of the volatility. And so when I look at some of the other details of the reports, healthcare and government, those are the areas where we've seen the strongest job growth. And that's not the best sign. To me, that's suggesting, because those are essentials, those are not cyclical. So in other words, they're not tied to the business cycle itself. There's not a lot of underlying strength with the cyclical parts of the market, especially with manufacturing. So the volatility, to me, is maybe just due to seasonal factors, and also really symptomatic of an economy that has gone from great to good, and it's trying to figure out, is it going to just kind of stay there at good, or is it going to get a little bit worse?
I do want to dive a little bit deeper into the Fed. You mentioned you expect a 25 basis point cut. This is being posted on Wednesday. The Fed decision is going to be tomorrow on Thursday. Do you think that 25 basis point cut is, locked in? We're definitely going to get that. And what happens after that? Is it another 25 basis point cut in December? What do you expect?
Yeah, it would be very unusual for the Fed to cut by 50 basis points like they did and then take a pause. So I think they almost have painted themselves into a corner of needing to do a 25 basis point cut. The data would support, I think, taking a gradual path towards whatever they think the terminal rate is. Let's say it's going to be around 3%. So that could be like an 18-month process in getting from where they started, where the upper end of the range was at 5.5, down to something closer to 3. So they could extend that period of time. But I do think it's pretty much locked in that they're going to need to deliver 25. A lot of the talk that they had back when they did cut by 50 was reassuring or reaffirming that rates, despite the cut, are still restrictive. So by cutting, they're not providing stimulus. What they're doing is they're basically easing off of the brake. So it would be quite a ways until they're actually pushing on the accelerator. So I think that really that 25 basis points makes sense. Probably another one in December, and then just continue at that cadence of 25 per meeting until maybe they get closer to 3.5%.
So Brian, the big event of the week is actually not the Fed meeting, it's the election. We're recording this a couple days before the election, so we don't know the results right now, but this video is going to post a day after the election. Can you give us some thoughts on, what the market reaction could be, not necessarily right away, but over the
Sure.
long term to a Trump or a Harris victory?
Yeah, we think that if over the long term, really the focus is going to be on debt and deficits in terms of that effect on yields. The bond market volatility has been very, very elevated. And a lot of it is because we are running deficits that you would typically expect in a recessionary period of time. So it's not exactly something you should see during an economic expansion. And a lot of the campaigning has really been more about tax changes, focusing on the revenue. We don't necessarily have a revenue problem so much as it is a spending problem. I mean, some of it could be a little bit of both, but they haven't really wanted to talk about the government spending in specific. So a lot of the discussion is likely going to shift towards spending. So when we think about that, the tax policy is likely going to change a little bit depending upon the outcome, but it's more about how is the government going to spend money, and then how is that actually going to affect the bond market volatility. The more volatility we have in the bond market, that then translates into equity market volatility because of the way in which you can think about, well, cash flows that a company generates in the future, you bring those back to the present using discount rates and interest rates. And so if those rates are moving all over the place, that's going to contribute to equity market volatility. So we expect that at least for the next few months, that we're going to probably see some heightened volatility in both the bond and the stock market. But over the long term, let's face it, corporate America is really good at making money. And they have done that under unified government, divided government, when it's been headed by a Democrat or a Republican. So we're pretty confident that with the state of corporate America, that they'll adapt and adjust to whatever the government throws at them.
How about the bond market, Brian? The 10-year yield bottomed out around 3.9%. I think that was actually 2 days before the Fed made its 50 basis point cut, ironically. And then it went all the way up to 4.3%. Do you expect we're just range bound between kind of 4 and 4.5, or could something break one way or the other depending on the election?
Yeah, it really could break towards above 4.5, I think, or below 4. So probably break out of this range depending upon what the election outcome is. We have to keep in mind that the Tax Cuts and Jobs Act of 2017 is the individual income tax provisions are set to expire at the end of 2025. So if we end up with divided government, we could be looking at another like fiscal cliff kind of situation as to, everybody knows they want to make some changes, but there's a disagreement about how to do it. And so as a result, do they come to no agreement, or do they actually come together and extend the Tax Cuts and Jobs Act? If they do extend it, that has budgetary implications because that is really going to be a reduction in revenue for the government. And then that could create the fear of more deficits, bigger deficits. And so you could see the 10-year break above 4.5%. But if we get unified government, depending upon what they're talking about, if it's these budget busters that they've been discussing on the campaign trail, again, the risk there is that you break above 4.5%, maybe move to 5. We think that most likely what we're going to see is the adults coming together, coming up with a compromise where we could actually see that 10-year come down towards 4 and maybe then towards 3.5% over the long term. So right now, as we're sitting here before the election talking about it, the risks to us are more that it's going to be a break towards the upside than the downside. But that's why we have the elections, and elections have consequences, especially for the bond market.
Absolutely. Great insights there, Brian. That's a great place to leave it. I really appreciate you taking the time to speak with us.
Oh, it's my pleasure. Thank you.